Let me now bring on board Rahul Singh, Head of Research with StanChart Securities. Rahul, good morning. Thank you for joining us. Rahul, what do you want to start with? A call on the Sensex, a call on ITC, or even better, a call on TCS?
These are three different difficult choices you've given me. But I think what we are trying to do right now, just to step back a little bit from individual stocks, what we are trying to do now is to figure out where there are dichotomies between where there have been earning upgrades and the stocks have not moved, or vice versa. So I would say that is something which we are definitely focusing on. TCS would fall in a category where there have been earning upgrades. The stock has outperformed significantly. So I think a material re-rating would depend upon further upgrades rather than just a simple P re-rating. And that's true for a lot of these companies which are huge in the huge outperformance territory, like Hindustan Lever, Ultratech, Ambuja. Whereas you have names which we found on our analysis where the numbers have got upgraded but the stocks have not moved. Could be for a variety of reasons, but that is where we are trying to focus our energies and attention on. And the names which pop up are Dr. Reddy's, Lupin, even JSW Steel for that matter. So that is where I think bulk of our effort is going right now. In terms of identifying these opportunities, because market might move sideways, might consolidate here for a while. We are at 14.5, 15 times 1 year forward multiple on Sensex, which is our long-term average. Now, basically two things have to happen if we have to go towards 16, 17 times multiple. One, there has to be a very clear evidence of a revival in capex cycle, and number two, there has to be a very clear evidence of decline in the risk-free rates in the economy, which is basically linked to fiscal deficit and credit policy. So pending these two, we think the market could move sideways for the next month or two.
So Rahul, do you think the delta trade in TCS is over? Because TCS as a stock, as a company, got re-rated a year ago when markets realized that TCS is growing and Infosys is not growing. But if I look at estimates, TCS is now not trading in early teens, it is now trading in late teens. So do you think the upside is now limited and restricted and they will have to do something extra special to go to foreign P expansion?
I would definitely agree with most of what you said. I think the challenge today is that in IT services, it's a large index weight, NMSCI weight. So really people, I think, are struggling to allocate money to this sector without having to look at Infosys. And that is where we think players like HCL Tech and Tech Mahindra will continue to do well, because they are still in extremely low teens kind of multiples. We think the re-rating there could continue, mostly driven by performance. Whereas in TCS, if the re-rating continues, it will be mostly because of scarcity premium and not because of performance. So we would say the risk-reward favors still, operators, the companies like HCL Tech and Tech Mahindra over TCS, and then followed by Infosys and Wipro.
If I look at your current model portfolio, you're bullish on asset owners, you're hot on names like Adani Enterprises and JP Associates. And there's a reason why I guess you're bullish on them, because these stocks are attractively priced, they've not seen a run-up, and the capex cycle could pick up. But if I look at the recent stock performance, Rahul, the beta trade has failed. Asset owners are not appreciating at a time when liquidity is strong. All the global liquidity is still finding its way either into FMCG or pharma.
I would partly disagree with that. I mean, if you look at the performance of JPA especially, the stock has done well, even though it's way off from its lifetime highs and so on. But the stock has done well from 70 to about 95. I think what is happening is that the investors are looking to buy options on the revival in capex cycle in India. And apart from L&T and BHEL, I mean, L&T, one can argue that it is getting into a slightly more expensive zone right now, even though on long term people might own it. BHEL has more single sector exposure for their fortunes. So really from BHEL L&T, the cliff in terms of the market cap and quality is quite steep, which is why I think some of the asset owners will do well. We like JPA and Adani both, and especially JPA has attracted some attention from the institutional investors as well, and the stock has done well. So I would say that there has been some additional weightage which has come into some of these asset owners. Some of the mid-cap asset owners have not done as well, which could be the second round in my view. But this round, most of the money has gone into L&T, BHEL, and then followed by the large-cap asset owners.
Rahul, what is your take on cement, and how positive are the prospects looking after what we've seen from ACC and Ambuja yesterday?
Yeah, on cement, it's been our non-consensus buy call from almost 2 years back, and it has played out, and we still think there is some steam left, especially in ACC and Ultratech versus Ambuja. I think there are two things playing out here. One, I think the pricing discipline in the industry, though people might call it by different names, I think it's been a function of the fact that the weaker players have had to attain those prices to service debt. So because the industry is heterogeneous in terms of how the balance sheets of different players have been, I think the pricing discipline is more a function of the smaller players having adequate debt servicing capability. So that, I think, has surprised the market, and that has happened even without any volume recovery or demand recovery in cement. Last 2 years have not been great for capex cycle and hence cement demand. Now I think the investors are looking at cement favorably, also not only because of the pricing discipline, but also because they see cement as a relatively risk-free option to play the revival in capex cycle instead of going and buying assets where there could be risks. So instead of buying, let's say, asset owners where there could be individual issues, there could be issues which can plague these asset owners for a long time. If the capex cycle revives, cement will do well because the demand growth will pick up, and that will lend further stability to the cement prices. And that part has still not played out, and that is where I think the investors are positioning, because you have some very good balance sheets, some companies with very decent corporate governance, so you don't have to really take those kind of risks to play the capex cycle, and that is what I think will keep the cement stocks, I would say, reasonably strong, even from here on, despite the stupendous performance over the last 1.5 to 2 years.
Well, you've used the word stupendous performance, but what about stretched valuations? ACC, Ambuja, if I look at the EV per EBITDA, that's the basic benchmark of measuring cement companies or cement stocks. ACC is 200 plus and Ambuja is also 200 plus.
See, I think you have to look at it in the context of a couple of things. One, the replacement cost in the business has gone up on a per ton basis. So the EV per ton metric, which we used to use 7-8 years back, is no longer that relevant right now. Secondly, if you look at these companies, they have, without raising capital, they have been able to generate a pretty decent growth in their capital employed and attained an average ROC of 20% plus. So I see no reason why that would not continue. In fact, that might go up even further. And therefore, one cannot look at valuation in isolation without looking at what has happened to the actual replacement costs in the business. So I won't worry about it as yet. I would start worrying about it another 10-15% up from here.
Rahul, too much uncertainty around the telecom space, and now the government has taken no decision on refarming ahead of the 2G auction. Would it be best for investors to stay away from this space for now?
I think we would probably stay on the sidelines for another month or so, because a lot of these decisions on refarming have to be taken before the auction start in November. So therefore, there is a time limit to it. We are seeing some progress, but we are seeing slow progress, and we are seeing a little bit of confusion on how much excess spectrum charge should be levied, not levied. But now I think the dust is settling down on that. The renewals also, the dust is settling down. I think refarming is the only issue where the GOM has to decide over the next couple of weeks or 3 weeks. So I would say just stay on the sidelines for a month, because this quarter results are also not going to be great. We are probably going to get to see the list of potential bidders in the auctions, which will be announced by the government on 21st. So there could be some nervousness on the stocks if Reliance Industries' name is out there in the list of bidders. So all things put together, I think mid-November, I would say, is when is the ideal time to look at the sector and reevaluate as to where things stand. But having said that, I think the signs that the pricing discipline, some sort of pricing discipline might be returning to the sector are there. So we've seen RCOM raising tariffs, IDEA trying to raise tariffs in MP. We could see more of these coming up after the auctions, because the cost for the entire industry is going to go up. So that's a good sign. But as I said, from a stock point of view, maybe another 3-4 weeks before we reevaluate.
Right. Rahul, even though it's a wait-and-watch approach when it comes to the telecom space, but going by the refarming recommendations the other day, it seems like this is going to be a huge setback for telecom players. What is your pecking order when it comes to telecom companies, and who do you think is going to withstand the blow, the best?
Okay, from a size perspective, although it will be negative for everyone if there is physical refarming, which I don't think will be the case, because refarming could essentially mean that the operators have to pay higher price for the 900 megahertz and not necessarily give up 900 megahertz. So it's not as bad as the headline might sound. But having said that, I think Bharti would be slightly better positioned because of the size and because of the relative impact vis-a-vis the market cap of these two companies. I think Bharti might be better placed to withstand that hit. And as I said, if there is refarming, if the costs go up, there are signs that the industry is now actually looking at things much more rationally and looking at raising the tariffs, which Bharti tried last year, but maybe in retrospect that did not stick, because it was the leader trying to raise tariffs. But now what we are seeing is that the weaker players are raising tariffs, so there are greater chances of these tariffs sticking. So I would say that once the refarming decision has been taken, which I think will not be, which is partly there in everyone's valuation estimates in any case, the focus post auctions will shift on what now and whether the tariffs can go up.
Rahul, what is it that you made of Reliance after its earnings, the sort of consolidation phase that the stock has gone into, and do you expect the gas price revision before 2014?
Well, the second part is very difficult to answer, obviously. The first part, after results, our view on refining is in the near term, it is headed downwards in the refining margins. So what we saw last quarter may not get repeated so easily in the next quarter and the quarter after that, because there are a lot of maintenance shutdowns which are now coming back on stream globally, which will bring the refining margins down, and some of it has already started to happen. So I would say I would look at stock. I mean, if it goes towards 750, it becomes a decent buy, because there are no earning triggers in the next 2 years, unfortunately. We see many more earning drivers 3-4 years out from the 3 projects which they are implementing, which will add almost 40-50% to the current EBITDA. But that's a little bit back-ended for the market to get excited by at this point of time, because most of the number upside from those projects we are talking about is in FY 16-17. So it will. I think the stock will be market performer at best for the next 3 months at least.
Rahul, historically I've always observed that big money is made when P multiples they expand or when P multiples they contract. So at the current juncture, Identify a sector for us where to your mind P multiples could expand, B, where P multiples could contract, and where P multiples may not go anywhere.
Okay, the P multiple contraction, I think the risk is maximum in some of the consumer stocks, because we are seeing signs of slowdown, but the market has not yet taken notice of that. So we are seeing slowdown in Nestle. Yesterday, Nestle, in their global results also pointed out to Asia slowing down. But the stock has not reacted. We are seeing similar signs in Asian Paints. So some of the select consumer stocks, we think some P de-rating could happen. In terms of P re-rating, I think it has to be the stress sectors. I think it has to be some of the asset owners and some of the capital good companies where the P re-rating could happen even before the earnings go up. Some of it has already happened. But as I said, it's all linked to whether the government can provide enough ammunition in terms of giving confidence to the market that the capex cycle is going to get revived. And that is going to be the single most critical driver of any P rating, not only for those asset owners and capital good companies, but also for the market as a whole.
Rahul, the odd one out from your current model portfolio is Reliance Infra. Now, what makes you bullish on Reliance Infra? Attractive valuations, their distribution business, or the fact that the EPC business now is showing signs of stability? Do you think Reliance Infra now could move from a damage control scenario to a growth scenario?
Well, it's not in our model portfolio, so there's some mistake there, I think. We think Reliance Infra, the downside is protected. I mean, we like Jaiprakash and Adani above Reliance Infra to be to exactly give you the pecking order. So it's not really high up in our list from a portfolio perspective or from the top picks in the asset owner space itself. I would say it's a moderate kind of a buy. It's not like a top pick material.
I got that one wrong. So construct a portfolio for us, a portfolio which you think after a 25% run up is still capable of generating a 15 to 20% return in next 12 months.
Yes, I would say our last portfolio, which we constructed in May, had a fair mix of beta and low beta. It had Hindustan Lever, at the same time it had DLF, and that outperformed the market by 4%. So really we are looking at outperformance here, and which is why I said the effort is to identify opportunities like JSW Steel, Exide, where the earning upgrades have happened but the stocks have not moved. Similarly, where we think earning upgrades could continue, like ACC, Maruti. So those are where the incremental beta is going to come from, incremental outperformance is going to come from. Index level is more a function of where the macro goes and whether there is interest rate cut, how deep of interest rate cut or not. And similarly, if the government can give confidence on the capex cycle revival. Those are the ones which will decide the overall market returns, which we'll have to wait and see. But the effort of the model portfolio is to outperform whatever the market does over the next 6 to 12 months.